What's up, guys? Dwight here with Defying Finance. I wanted to go over something briefly to see if I can answer some questions I typically get about investing and kind of the macro perspective of inflation and what happens if you don't invest, right? I made a little spreadsheet, a very simple spreadsheet. I want to show you something, just comparing cash to different goods and the S&P 500. And I also want to show kind of the effects of inflation from printing money. Remember, the printing of the money or quantitative easing, when you hear these types of things, that is inflation. It is not the rising prices. Rising prices are a result of inflation. Go look at any dictionary. I think it's before about 1991, and you will see inflation is the expansion of a money supply or a currency supply. This was just conveniently changed to meet the government's ability to manipulate their consumer price index so they can pull stuff out of this basket of goods and make it look as if inflation, price inflation is what they call it, is lower. They can say, oh, look, inflation's only 3% or 5%. In reality, if you went back and you measured a way that they did back in the 70s, you would see that we're a lot higher. We're at 14, 15% interest, we wish, inflation right now. But let me bring this up. Let me go do a screen share here. All right, let me hide this. So try not to get ahead. I know I have a couple things on here, but I just want to go back to the 50s. Many of you have heard your parents, maybe they talked about how candy bars were like 5 cents back in my day when I used to walk to school barefoot in the snow, all this type of junk, right? Well, if we take a look at this, I think I have it zoomed in enough for you here. 1950, let's say candy bar is 5 cents. S&P 500 was 1705 at that time. That means the S&P 500 was worth 341 candy bars, okay? And if we take the same year, okay, or same two sets of data here, candy bar versus S&P, in today's price, now for me, where I'm at right now, candy bar is about $1.29 for a Snickers bar or something, right? And of course, this might vary some depending on the state you're in. There's different levels of taxes. But the point is, the S&P 500, you will find out tomorrow at the time I'm making this video, at least. It's on a Sunday, but the pre-market S&P 500 is going to open up low tomorrow. But anyway, the point is, it is worth 3,168 candy bars, even though candy bars have skyrocketed in price, right? What is this? That's a 20, 25, some odd X gain that candy bars had against a dollar, right? That's important. A key word, against a dollar. So it's not that the candy bar went up in value. It's that the dollar has fallen in value. Like, this is the same candy bar. It's the same peanuts, right? In fact, technology has gotten even better. Wages have technically got lower because we're using machines. It's the same chocolate, right? You're using the same wrapper. We have better technology to get the oil out to make the wrappers, right? The point is, the dollar is collapsing over this time period. And here's a perfect example. If your grandpa, great grandpa, whatever, grandma, stuck $17.05 under a mattress, you can only get 13 candy bars. That's all it's worth today. So you have dramatically lost your purchasing power by stuffing that under the mattress. And today, stuffing under the mattress is the equivalent of sticking it in a savings account or high yield savings account. There's no interest, right? You're dying to inflation, your purchasing power. That's why Robert Kiyosaki, in his book Rich Dad Poor Dad, this sounds bad, but it's true. Savers are losers. They're financial losers, meaning you are losing your purchasing power to all the things you want to buy. So unfortunately, the government has put the whole world, all these governments around the world that are have been printing money forever, right? Everybody has to become an investor now. Unfortunately, that's just the way it is. Now, there are some simple ways to deal with this, but let's continue through this real quick. So if we look at a Corvette in 1963, a basic Corvette was $4,000. S&P at that time was $73. You could already see the increase over those 13 years, right? In dollar terms, of course. Now, 2022 basic vet, 62,000 bucks, S&P 500. Here's your difference, right? So back then it took 55 shares of the S&P 500 to buy a Corvette. Today, it's 15 shares of the S&P 500 to buy a Corvette. So technically, you're gaining purchasing power, right? This is good if you were invested in the S&P 500. And I don't remember if I've said this yet, but remember, we're not talking about dividends that you're getting in the S&P 500 either. That really makes it even better. Now, this is something I took, which was my grandma's house. I want to show you guys. You can see I have some tabs up here. I want to show you kind of what you can look at for just a very basic thing. Okay, so stay tuned. I'll try to be quick here. But my grandma's house here, I'm outside of the Sacramento area now, but during that time she lived in the Sacramento area. They bought this house for around 16,000 bucks. Okay, and the S&P 500 again was $73 at that time per share. It was 219 shares to buy that house. So if you had 16 grand sitting around, it's, do you buy this house for 16,000 or do you finance it? Now at that time you had to put a lot more down. Today you can get away with putting very low amount of money down. But if say you could do 100% financing to keep this really simple, if you could finance it at 16,000 and still service that debt, meaning you can pay the payment, and then you could take that 16,000 and stick it in the S&P 500, you could see the benefits, right? Here's the deal. So the S&P 500 had obviously increased dramatically against the dollar, remember. But housing really increased a lot too. But here's the difference. Now, it used to take 219 shares to buy that same house, and now it only takes 110. Now, you can see if you look at this by itself, right? Obviously, it's had an incredible run. Okay, this has also had an incredible run. Both of them have went up dramatically in terms of dollars or dollar value, right? But if you compare them against each other, you can see, what's outperforming the other. So obviously, the S&P 500 outperformed the housing market, but the housing market still did incredibly well compared to other goods you would try to buy. Like this is a real asset. Now, Robert Kiyosaki would disagree with that because your home takes money out of your pocket, doesn't put money in it. But what if this was a rental property, right? But anyway, I want to go down to one other thing because a lot of people say, gold has no value and blah, 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 blah. They're wrong. Okay. So this is the same type of thing. We take gold back in 1950s, about 35 bucks an ounce. I know people say that it was confiscated after 1933 and, into the 70s, you still couldn't technically own gold as a United States citizen, right? But that wasn't true. It was really, you would call it nationalized. They didn't confiscate it, not give you anything. You had to bring it into certain banks and they would give you, what was it? I think it was like 25 bucks for that gold. But of course, the government revalues gold, meaning they devalue the dollar against gold once they had everybody's gold, typically what a government does. But anyway, the point is, it took two of the S&P 500 to buy an ounce of gold. And here, now you can see gold doesn't get you much of the S&P 500. So this is saying the S&P 500 has outperformed gold, right, in that long term. Now, but that's looking at today's price. And right now, we're heading into a recession. At the time of this recording here in 2022, it's May 2022. I don't know when you're watching this video, but this is going to dramatically change. So as this falls, this will increase. And typically it always goes back. I want to show you something. This here is the Dow gold ratio. Let me see if I can zoom in for you a little bit to get that more visible. Okay, so this is a Dow gold ratio. This is why ratios are really important. So you can see what happens. This is how many ounces of gold does it take to buy the Dow. So looking back at that spreadsheet I just showed you, it looks like, oh, look, the S&P 500 is outperforming gold. Well, it has right now at this particular point, but this is typically what happens right here. So the Dow is the only one I have the ratio on, but you can see it drops down to a point where it's, this isn't a daily chart, but if this was a daily chart, I don't believe it's a daily chart. I don't think it says. No, it's a monthly chart. Daily, it actually fell all the way down to 1. So it took 1 ounce of gold to buy the Dow Jones. Now, I don't think this goes back far enough. Yeah, it goes back pretty far though. But you can still see in the Great Depression, right, during this time, 2 ounces of gold. Now, I think it fell back down to about 1 on the daily chart here as well. But the point is, it usually returns to these levels on these extreme times. And we look at the 70s and the types of inflation that we're having right now. It could be like Lynn Alden says that we're more in a time of like World War II. Could be, but I see it more like a mix maybe between the 40s and the 70s. But my point is, you can see how gold performs over the long term, especially in these types of times, right? So you can totally see this number coming back down dramatically. So that brings us back to this chart here. Zoom out, where I think this is obviously going to change. Like, let's say this drops down to 3,300, which was the pre-pandemic level. Oops, that keypad's not working. Not quite there, but of course, this is without gold moving at all. Okay, so if we go into a 2008 type of stock crisis at that time, obviously this moves up dramatically. So it's either the S&P comes down or gold could go up to. It doesn't really matter because we're looking at a ratio here. So let's say, like Bank of America is talking about, gold heads to 3,000 and we have just a stock market crash. Let's say this goes to 2,900. They're talking about a 5,000 level or whatever, but you can see how this ratio continues to change. That's my point. So really, you can play these types of swings in the market where you have these long-term runs, and it's, oh, look, right now I should probably get ready to buy more gold, right? A very simple thing to do, where the gold ratio changes dramatically. You're buying up gold and then you swap that gold for other types of assets that have got beaten up. So this is, as you see this number goes down, gold is going up, or the stock market's coming down and gold's sitting there. Whatever the point is, that the ratio is going down. So you could swap for those types of swings. You could do the same with real estate, right? But anyway, I just wanted to show this because it's really important, and this is why this is happening. That blue line is the money supply. So you can see what's been happening for a really long time. This is what they call a hockey stick, meaning this is going to the moon. You're heading into hyperinflationary type situations. This red line is a trajectory that's clearly it's been following for a long time. This could come back down to this line, flatten out, kind of like this actually, if you look at that. But it's dramatically increasing. So we're heading into some really weird times. Now, this has taken a long time to get to this point, but that's why you see prices continue to rise, right? You see that inflation show up in these different asset prices. So if you are in those assets, this is why the poor end up staying poor, right? They're not in these types of assets. If they can't save up enough to get something in there, right, then they don't get the benefit of these runs. And it's unfortunate. But this all, you can see that the prices here, this is created by the government and the Federal Reserve, which isn't part of the government. That's really a private bank. So here's some things I just wanted to show real quick. So tomorrow, now I wanted to pull up some information where you don't have to be signed up for accounts, paying subscription fees to use different stock places. Okay, just a simple way to Google something and get some basic information. Okay, let me go back to this. Hopefully you can read this well. So this is all your pre-market data. So you can see the Dow Jones tomorrow so far, not that this can't change. It's going to open up down 300 or so points. We'll see what happens with that, if it stays there overnight or not. What time is it right now? It's about 9 p.m. here in California where I'm at. So we'll see. This is the implied open. The S&P 500, it looks like it's going to have a little bit of a down day. We'll see what the futures are doing right now. So you can Google this information on a daily level just to see, hey, what's going to happen tomorrow. If you're trading, if you're not trading and you just want to invest for a really long term, like I might consider doing with most of my money. And again, I'm not trying to give financial advice here. This is just a very broad trying to give a broad visual of what somebody might be able to do. And the reason you hear a lot of people say this isn't financial advice, the reason they have to say that is because I don't know who I'm talking to on the other side of this lens, right? I don't know who you are. I don't know how much you make, what your financial situation is. So you can't really tell someone what to do. It's really, hey, here's what I've done, or here's what I would do if I was in X situation. So I just want to make that clear. But this is something people can do to analyze data, right? To do something very simple for themselves. Now let's pull this up. So here is a log scale. Here's what the S&P 500 looks like over a long period without a log scale. But you can see from printing all this money, you could draw a line. I mean, look at that. Look at the support levels of this. Now, as long as the government keeps doing what they're doing, you're going to continue to see this go up in dollar terms. But the question still remains, what does it buy you, right? If you head into an incredibly inflationary time, this is going to go to the moon. But what becomes more important is your rent, your food, water, maybe gas, right? So this could fall in value compared to those types of good, even though you see these dollar amounts coming up, just like we saw back here with real estate, right? You can see that, wow, look, real estate's increasing a ton, but guess what was increasing more in dollar terms? The S&P 500. Well, you could see that in reverse with something like, beef and bread and whatever, right? So keep that in mind. But going back to this, this was a very simple thing that you can Google. You can go back and look at these really long-term charts. But what I like to look at are PE ratios, right? It's a very basic thing you can look up real quick and say, hey, is the market overpriced? This is the price of the stock compared to the earnings that these companies are bringing in. Right? That's the point of buying a company. You're not buying a company because you think the stock price is going up, right? Sure, you can trade that, but that's not an investment strategy where you buy something and you hold for the long term. This is a very basic way to look at it. So you can see right now, going way, way back in time, the stock market, the S&P 500, is an expensive buy right now. So when you're looking at, Tesla and you think, yeah, the price is going to keep going, don't get stuck on the price. You have to know what their earnings are. You have to know whether, the ratio is even worthwhile, because you could see what happens. Look, this was 2008. We're way above that right now. We're above Black Monday. This is before 1929. This is the dot-com bubble. It's an expensive market right now. So I don't think it's a good time to be in this yet. Now, there are specific stocks within the S&P 500. I'll show you. You can go dig through and find some that are below this. But here's another one here. This is a 90-year historical PE ratio chart. This was, where's that? This was a Schiller PE ratio, right? There's some differences between those I won't go over, but I want to show you what you can do. So maybe you decide, hey, let me pick a stock that I like, or I'm hearing in the news, or something that you use. I have Netflix. A lot of people have Netflix. So let's just look at that for the time being. Now, I just Google this. I'm not paying for the subscription here. I just want to Google it so you can view this yourself, right? So let's look at Netflix here. Now, we know Netflix has gotten just killed on their stock price. In fact, do I have it up here right now? If you didn't watch one of my other videos, I did go over it. Here we go. Right here. I mean, look at this. They're just getting body slammed in the market here. And let's see. I don't need to do that. But I'll show you percentage wise. I mean, they're getting crushed. Look at this. They're down 75% from their high. Right? They completely crashed. But this is why PE ratios are important, because that stock's value might be here, right? Or it might be realistically here. when you start looking at PE ratio, what are their earnings compared to the price of that stock, which means you have a giant delta. Okay. So this stock can fall anywhere between this fair value range, right? Or this would technically be fair value somewhere in here, probably, right? The point is, it can sell off really hard at any point into these areas. So you want to try to get stocks based on what they're earning, right? So let's go back to that. So we see their stock price. Here's their trailing 12 months. This is their net earnings per share. So how much they're making per share of their common stock. Okay. So you can see, obviously, the trend was it's increasing. But look at their PE ratio. So right now, look at this. The PE ratio is at 16.42. Now, some people might say that's not, great yet for Netflix. I think that's actually getting to a very fair place to buy Netflix right now. Okay. Let me show you why. If we go back, let's see, 16.66 in 2011, that says. Let's go back 2010. It's actually cheaper than it was in the 2009 crisis in PE ratio terms. Look up above this. You see how it says 7.87 up there at the stock price? If you could even read that. Let me zoom in a little bit for you. I don't know if that zoomed in much so you could see it, but you can see 7.87 as a stock price. So obviously, when you look at this, you say, oh, the stock price is 180.97. What are you talking about? The point is this: you're looking at their earnings. Their earnings were much lower at this point, or actually, my point is the stock price looks like it's lower because it is, but the point is we're looking at the earnings ratio. So you can see when it was getting incredibly expensive, you're paying 450 times what their earnings is. Back here, 2015, 408 times what their earnings were. So look, if you look at it from this perspective, since 2015, Netflix has been crashing in terms of earnings, right? The compared to the price of their stock and the earnings that they're bringing in. Even though the earnings were going up, the stock price was just blowing through the roof. It's completely unrealistic, right? This is why I was talking about places like Tesla. You got to be very careful with those types of things, and it's hard to short something that's like a cult following, because it can outperform your options and then you get killed. So you got to be careful with that too. But the point is, you can see you're actually buying the earnings of a company for cheaper than they've been in a very, very long time. So, of course, not that they can't go bankrupt or something, then you lose out on your stocks, right? But the point is, I'm looking at these types of things to make investment decisions. Okay, let's keep going. So this is something you can go Google too. So you're just looking at the stocks that are within the S&P 500. I showed this a little bit on another video of mine. Let me make this a little bit bigger for you. So you can scroll down here and you can literally pick through these companies in the S&P 500. Okay. And over here, you can look at their 1 year performance, for example. So we can see 3M is down 23% over a year. Right? That's bear market territory. There's a lot of great companies in here. Let's go down. Oh, I have another one pulled up here. What's it called? Align companies. Let's see here. There we go. This guy here, look, 43. Wow, 43%. I think I got another place. So I Googled another one. Companies, components of the S&P 500 to show another website. You could do the same type of thing, right? Where you can scroll down, go through these companies, see what their year over year price is. You can look at more details where you can click on the plus sign and bring up all these different companies. You can look at their technicals, the key stats, ratios. Now, again, I'm not paying for this site here. Okay, let's see, where is... Anyway, that company's here somewhere. My point is, right here. So say I was digging through these companies and I say, well, this one looks like it's down a lot. What's the deal here? Right? I can click on ratios, start digging through these and look at those same types of ratios. And then maybe I Google a little bit more. I want to know, well, what's a more historic level for them? So same type of thing. I Google their PE ratio. I can pull it up here on the screen and just take a look at it. I can see their earnings per share have been climbing steadily over time, right? Many years of data here. I can see the PE ratio at 31.58 compared to 94 at a high in 2021, 102 in 2018. Let's go back here, 130 back in 2013, and back in 2009, don't have any data. I wouldn't even include this one. I don't know what's going on at that time, but you can see right here in this 20 range, it was there coming out of um, the issues we were having in 2008. And we're getting really close to those levels now. So I'd be curious and to start digging into this company even more. Here's some other ratios. You start to get into more accounting methods here with your current ratio, current liabilities, and all this type of junk. So you'd want to be looking at debt and whatever. But that starts to get definitely more advanced. But these are quick, easy things that you can do yourself to try to start analyzing some data, because there are good companies right now in the S&P 500. Oops, that's one of my Binance wallets there for crypto, that you can dig through these companies and see, well, who's getting crushed right now and why? Like, what's going on with their stocks? Who's climbing through the roof right now and why? Like, look at this. CF Industries Holdings up 91% over the last year. They're just killing it, right? But why is the question. You can start looking at all their data on the initial screen here. You can go back to that other place and pull up more, but this is a really easy way to start digging into companies. Oh, so let me make that a little bit bigger for you. Digging into companies and picking these out, even though, yes, there might be some more risks in the stock market, right? But with Netflix, you have to start asking yourself, how much more risk really is there at that PE ratio? There's a psychological component, sure. So it can sell off even more. Amazon, I think, is down, man, almost 30% right now from their high, right? But of course, they probably have less debt, and Apple, similar situation. But these types of stocks can carry the S&P 500. So they're heavier weightings in that. So it looks like it's going up when really everybody else is selling off until those big ones start to kind of drag those numbers down. But you can find good deals out there. So this can be very, very good news for someone who is prepared for this type of situation in these markets. So a little bit of training, jump on YouTube, watch some videos on PE ratios. There's some great stuff out there that you can learn. It's very easy to dig into this type of data and start picking some companies that you might like. We're going to go through a time right now that's going to be incredible for buying in just huge name companies. I believe we're going into a massive stock crash, but remember, that can change depending on what the government does, right? If they start printing a bunch of money, you can see the dollar value of those stocks climb to the moon. But again, what does it buy you, right? You may just be running into a situation where you got to get rid of those dollars because you're losing that purchasing power compared to that asset, right? Your candy bars, you're buying less candy bars is the point. But anyway, I hope that was helpful. If you thought that was helpful, I'm going to ask you to subscribe. Also, if an ad pops up, I'm not running any ads right now, but eventually, I don't know when you're watching this. You'll be watching this 3 years from now. Just watch an ad. It's free content. I'm not asking for any money from anybody. So I hope that was helpful. And there's just a lot of really good information out there for everybody. And unfortunately, we're all forced into the situation where we have to start learning how to invest. And it's probably better for us anyway to take control of our finances because you can ask better questions to the professionals that do that investing for you, that are managing your 401ks. That's really important to ask the right types of questions to those people. And maybe I'll make a video on that. Actually, that might be a good video to make. But anyway, Um, Hope that was helpful. Have a good one.